Hi, everyone, and welcome to this week's episode of Market Drivers. I'll go over the three scenarios for the future of the economy. We'll take a look at their bear case. Their bear case is generally centered around the Rona and its seeming resurgence. I'll go over their base case, which is the most likely. The base case is centered around staying basically where we are in terms of economic activity and predicts a 3,300 price target by the end of 2020. And then I'll finish up with the bull case. The bull case is centered around things obviously going well and has an S&P target of 3,500. As always, there will be some jelly at the end, which is something I enjoyed outside of the markets. If you have big dreams like buying this 5-bed, 7-bath mansion outside of Vail, Colorado, or if you're just getting started on your financial journey, definitely like and subscribe. It has a modern open concept floor plan, but still has that in the woods feel. It has a nice sitting room with amazing views. The master bedroom also has amazing views and a fireplace. Kind of a narrow master bath at this price point. It's currently on sale for $5 million. To keep your dreams at the front of your mind, like and subscribe. Welcome to the Portfolio Bulletin. Let's get started. First up is the three scenarios of the Rona. First, it lays out the scenario. So it talks about the jobs that were gained in June, which was 4.8 million, which still leaves around 20 million Americans out of work. It also talks about how 2.6 million Americans have been infected with the Rona and over 128,000 have been killed. It then talks about how the S&P 500 went down 34%, plunging it into a bear market. And since then, the S&P 500 has re-entered bull territory in its rally since March. It goes on to state that the economy still has a long way to go to absorb the millions of currently unemployed workers, and that because of these, consumer spending will be down, which will threaten corporate profits, as well as tax income for state and local budgets, which I would argue is a far bigger threat. Next, they talk about the shape of the recovery, whether it will be a V shape, a U shape, a W, or the Nike swoosh. And it seems like the Nike swoosh is kind of what it's looked like if you look at the S&P 500. They continue to set the stage for what the second half of 2020 will look like. It says many companies and states are reversing or delaying their reopenings with a new sense of caution due to the Rona resurging. But at the same time, hiring in May and June showed momentum. But that momentum still has a long way to go to build up a healthy job market. Moving on to the bear case, they say it's easy to get bearish with all of the economic data coming out over the past few months. However, the job recovery has been more robust than anticipated. Over the past week, Arizona, California, Georgia, and Texas have all reported higher Rona numbers, and California went as far as to close all bars and indoor dining again. The next section is not really about negatives, but it does talk about a lot of uncertainty. They call this the continuation of the first wave, which means we don't know what the second wave will look like or the timing of the vaccine. They go on to mention whether schools will open, or if daycare centers will be open, or if working parents will continue to be impacted by the lack of childcare. Further, they talk about whether the unemployment benefits that expire in July will be extended. That's the extra $600 per week that unemployment is currently paying out. Will state and local governments receive adequate funding to fill in the gaps from tax revenue losses? The state and local government piece of this section really carries the most weight. That's tens of thousands of jobs that would potentially be lost if state and local governments can't pay their people. And they're really dependent on the federal government at this point just because state wages have gone down so dramatically with all of the lockdowns, which to me is another reason that some of these states cannot really afford to close down again. Next, they give Paul Singer's opinion. He says his outlook is not disastrous, but it's also not optimistic. He says part of the trouble of looking at the economy is that the issues are not so obvious. Small businesses have been the hardest hit, and those are not publicly traded. Therefore, the stock market is not going to reflect as much of the effects on them. Next, it says the bear case would feature a widely available vaccine by 2022, as well as strict lockdowns put back in place. Morgan Stanley is predicting a minus 10.2% GDP for 2020, while as Oxford Economics is predicting a minus 17.2%. Further, Cornerstone Macro predicts a minus 20%. All of that would roughly translate to around 2,500 for the S&P 500. UBS Private Wealth Management estimates 2,800 for the S&P 500 by the end of the year should everything go wrong. All of these projections seem fairly moderate to me, considering that we saw a 34% drop in March. If the worst I'm looking at is 2,500, then maybe I should sit in a little bit of cash but continue to buy. Moving on to the base case, which they say is about 50% likely, whereas the bull and bear cases are 25% respectively. It says the base case has three things factored in. First, that the Rona will stick around for an extended period. Second, that the Fed will continue to support the economy. And third, that Congress will provide at least $1 trillion in additional aid. All of that seems fairly reasonable, considering what Congress has already done and how the Fed has been acting so far. It says under the base scenario, a gradual lifting of lockdown restrictions continues and the existence of a vaccine or therapy by the fall, with mass production in mid-2021. All of that would allow for a moderate recovery in third quarter of this year and a return to normal by the end of this year or the first half of next year, giving the S&P 500 a target of 3,300. Based on all of that, they expect a sideways market. Also, unemployment will remain in double digits through December. He goes on to say we are still in a place of irrational exuberance in terms of equities, and he says the S&P 500 is trading at 22.1 for price to earnings ratio, which is not far off of the peak in 2000. This is a chart of price to earnings over time. You can see here in 2000, price to earnings was right around 26 or 28.59-ish. And then it rallied up into the 2001 kind of dot-com bubble. Then we dropped pretty dramatically into 2006. Then again, rallied up really high because of the Great Recession. So earnings went way down, which caused the price to earnings to go way up, even though the market dropped 50% during that period. And then we dipped way down as we kind of recovered from that a little bit. And then we rallied up. And then we had a little dip here at the end of 2018. And then currently we are sitting at around 20.34%. What's not depicted here is that we'll probably see this rise pretty dramatically into the upcoming months because Q2 is going to have a pretty large drop in terms of earnings, which will cause the price to earnings to go up pretty dramatically because the price has not gone down very much. It says here the CIO of Morgan Stanley Wealth Management also predicts a trading range between 2,900 and 3,200 for the rest of the year. She goes further and says, we are not interested in owning the S&P 500 right now, despite Morgan Stanley's deep conviction that a V-shaped recovery will occur over the next 4 to 6 quarters. She goes on to say that we've gotten all the good news we've expected. However, corporate earnings now need to catch up. And she says she encourages stock picking in areas leveraged to the economy. She goes further and says that materials and energy stocks are her primary choices because they are cheaper than the broad market and they are leveraged to the economic recovery and correlated with fighting inflation. All of this together basically says they expect the market to trade sideways for at least the next year or two. Finally, getting to the bull case here, it says while we are not overly optimistic, it might be a good time to rein in our optimism. For this scenario, we assume that the economy and the stock market has seen the worst already, but that is kind of contrary to the rising Rona numbers and subsequent delayed reopenings. It says here, strategists say it would take a vaccine widely available before the end of 2020, as opposed to mid-2021 for the bull case to take place. It says here, while the bull case is unlikely, it has a price target of 3,500 in their upside scenario. They also mention that this means returning to absolute normal prior to the end of fourth quarter of this year. Despite that, they expect unemployment to remain above 10%. Next, it says data from Apple shows mobility across the country has improved greatly. Strategists from Morgan Stanley say their bull case includes faster reopenings and greater mobility, which would lead to a normalization of economic activity. It then says if all of that happens, GDP would only be down 2.1% for 2020. Next, Cornerstone says that the reopening and return to normalcy provides a catch-22 for the bull case, because the normalcy that's needed for the economic recovery to take place will cause more people to test positive, leading to greater hospital occupancies and thus triggering more shutdowns. And for that reason, Cornerstone doesn't see an S&P 500 above 3,400, even in their best case scenario. The last bull case mentioned here is from Bleakley Advisory Group. It says even the bull scenario has a bearish lining because if there is a vaccine that's widely available in October, the stock market will love it, but the bond market will not. They say it could potentially lead to a rise in global interest rates, which would make the relatively high stock market evaluations even harder to justify because ballooning corporate debt will make these companies less valuable. It will also cause problems with household debt and government debt. They then reiterate that a vaccine coming sooner rather than later will help increase demand, but will bring forward inflation pressures, transforming a bullish outcome into a bearish one. In conclusion, it says whether the U.S. economy takes off from here or stumbles into the rest of the year, strategists tend to agree that the S&P 500 will trade in a pretty tight range for the rest of 2020. It's interesting to me that all of these people from all these various organizations seem to have a pretty common understanding of what's going to happen. Whether they believe in the bull case, the bear case, or the base case, each of their understandings of each case was pretty similar. Anytime I find that to be true, I generally think that that will not happen. Just like everybody thought that the market was going to continue to fall and that the bear market rally was going to reverse, yet we continue to sit in the same range. So just keep that in mind whenever you see all of these analysts saying the same thing. It should make you a little bit weary. Let me know in the comments below whether you think we are in a bull, bear, or base case. Also comment your investing plan for the rest of the year. Definitely like and subscribe if you got some value out of this video. Of course, none of this is financial advice. This is all for entertainment purposes. And with that, let's get to the jelly. So today's jelly is the fireworks celebration in Los Angeles. Apparently, Los Angeles County decided to cancel all of their public firework demonstrations, and also all fireworks that left the ground were considered illegal. So all of these fireworks going off in the sky are illegal. But after all of the lockdowns and all of the public beaches being closed and all the various things that the government has done in California, it seems that the population of California has kind of gotten tired of that. So here's what their fireworks celebration looked like from a drone. Here's a look at it from a different angle and a little better camera. As you could tell, there was fireworks as far as the eye could see in every direction. Californians just did not care about the rules surrounding fireworks, and good for them, because it's Independence Day and it's kind of the spirit of the season. Definitely like and subscribe if you got any value out of this video, and have a great day.